Hey everyone, it's Paul with your Tuesday YouTube video that is actually being recorded early because I'm going to be away, and still I wanted to make sure I got this video to you because, hey, we try to do our best all the time. All right, I wore this special t-shirt today because you know what? These stocks, I should say, actually, maybe after you watch the video, you'll say, well, maybe, Paul, it was a little bit like rocket surgery. But first, let's do business as usual. Disclaimer, yeah. Geez, I skipped down to the second line. This video, all of the updates, all of the content material for my company, Atg Digital Media, is not investment advice. It is information, entertainment, engagement, opinion, not investment advice. Number one factor in investment advice is that it's rarely given for free. It costs lots of money, usually thousands of dollars every month. Next, past performance does not equal future results. Errors, mistakes, oversights, they happen because, hey, we are human beings, and stuff like that is a human thing to happen. Capital loss is a likely outcome. In other words, you should consider before you act on anything that you hear or see, read, etc., that things don't always work out. But if they do, hey, that would be pretty awesome, right? I think so. Finally, I, the owners, contractors, employees, associates of Atg Digital Media, own, trade, transact in the investments that are mentioned in this video, that are in our updates, that are in our model portfolios, in my tweets. What else? I think that covers the vast majority. I mean, we're on other social media too, Instagram, Facebook, not Snapchat, but I mean, you get the idea. All right. Quick plug for Atg Digital Media, which is my company, and we sell subscriptions which start at $9.99. So that's less than $10, because sometimes apparently there's confusion. People think it's $999, like $1,000 a month. Yeah, not $1,000 a month, $9.99 per month. So kind of like Spotify, Actually, we modeled it kind of like that, where it's like a really cheap subscription. That's the sort of like the introductory tier. What do you get for that? Well, you get a laser focus purely on innovation, growth, stocks, and crypto. So, for example, we don't really, we don't cover things like banks or oil companies. We have a forward-looking view on the world. We have I don't know what to call it, innovation and growth mentality. We look forward, and those are the investments that we believe in. That's the world that we focus on and that we want to unfold. And so that's what we invest in. That makes sense, right? Yeah. So stocks, crypto picks, updates, market strategy, commentary, and you want to check it out, then there's the Substack, which is completely and utterly free. In other words, I mean, we actually, obviously, you can get an example of our thinking, how we think, what we're focused on. Stock picks, Dean and Dan and Wyatt, they all write. And in my Substack, I obviously write. And I do a mix of sort of like some amount of macro commentary, stock picks, but you want to check it out. It's completely free. And we don't tease stuff. We don't play around and waste your time. We actually tell you the name of the stock. We'll give you some, very rapid analysis, tell you why we like it. And then, hey, if you like it, hopefully you'll want to subscribe. All right. So I did say that after, I should have probably just like torn all these off. So I'm going to try and tear this off. And hopefully I won't tear any of the notes. So I used to call them slides, but these are slides. I mean, these are paper notes, essentially for me to keep track of sort of like my thought process, because many of these ideas kind of like wander around, and you kind of have to like shepherd them into sort of like a mental process. But today's video, you know what? It's super interesting, super curious, and it's gone on a long time. And so you just gotta like keep all the details in mind. And I'm gonna just shrink this down to the bare essentials. So like those folks like, well, Paul, you didn't tell us that. You didn't tell us this. I'm trying to keep this short as possible. All right. So today's video is a follow-up on videos that I have done on this. I cannot remember, we'll pop it up there to watch the old video on Fannie Mae and Freddie Mac. So this is like a ongoing saga, like a Viking saga, like, yeah, with the horns on their head, horns. I should get back to the point. So the Fannie Mae Freddie Mac saga has been going on since 2008. Essentially, the global financial crisis created this saga. That happened in 2008. The bottom line to it is that in 2008, the government took over. And it did it in a very particular way, which you should understand, because it becomes relevant later on, which is that the government takes over because they're like, hey, you two companies are running out of money. You're going to need money. And you shouldn't have done some of the things that you did. You got yourself into trouble. So we are punitively going to take a 79.99% stake in each of your companies, essentially wiping out the existing shareholders. Yeah, the government did that in 2008. Now, I put this Y down here because I wanted to remember to tell you. So why the 79.99%? Well, people don't know, but the government is, I'm going to start with the bottom point though, is in the end just a giant corporation. I mean, it's a giant holding company. And it owns all of these other corporations that are registered under it. So it's got to follow accounting rules. Yeah, I mean, so if you own more than 80% of a company, you would have to consolidate that company into your balance sheet. And if that's what you're doing, you have to also then consolidate all their debt onto your balance sheet. And in 2008, the government looked at Fannie Mae and Freddie Mac and said, yeah, we don't want to do that. How can we get around this? So they got around it by only taking a 79.99% stake. And so they've left, 20.01 sitting out there in FNMA and FMCC, which in technical jargon you'll call, those would be like the stubs that are left after the government took its 79.99% stake. All right. Fast forwarding very, very rapidly. In 2010, the government did something that, in my opinion, and in the opinion of many shareholders, many hedge funds that have gone in and out of Fannie Mae, stocks and preferreds, they went and implemented something called a net worth sweep. And why do they do that? Well, because the government never imagined that in 2008 that these two companies were going to recover. They really thought that they were fatally wounded, that they were going to go bankrupt, and that they would sort of like linger in some kind of purgatory forever. Yeah. Instead, what happened is that, well, the housing market picked up. The losses weren't really as bad as what everybody imagined they were going to be in 2008. And then it kind of turned out that like some of the losses were paper losses and they were recovered. Well, when the government saw that, they didn't like that. They are like, yeah, that doesn't fit our plans. We kind of like the old plan of where you being in purgatory and not making money and not becoming something that actually benefits the shareholders. So yeah, the government decides to implement this net worth sweep, which effectively takes all the profits from the companies, keeps it for itself. Yeah, I mean, there's something called the takings clause in the Constitution, and many people have gone and sued the government again and again, but judges after judges just refuse to rule in favor of the shareholders until like a couple of weeks ago, when on August 14th, and Dean just flashed the story up very, very quickly from, I think it's Mortgage something Daily. On August 14th, 13 years essentially after the net worth sweep, A jury, not a judge, a jury. Important distinction, a jury. So regular people who have a non-technical but understanding of sort of fairness and the law and how it should be applied, ruled in favor of the Fannie Mae and Freddie Mac shareholders. And they awarded the shareholders $612 million to the shareholders. And then about, I don't know, I think it's about 10 days later, yesterday, I started to see Fannie Mae and Freddie Mac stock going up again and trading picking up in the preferreds. And I was like, what's going on? So yeah, when I went on X, previously Twitter, and searched for the ticker and found that there were these stories. I'll put up a couple of these tweets showing you what it says, which is that the court apparently awarded a prejudgment interest on the $612 million award. All right. So to make that clear, what is a prejudgment? In other words, court effectively said, well, you know what? Yeah, the 612 million, yeah, that award, well, the shareholders also do interest on that. So you gotta like start to track this back to some date, right? I mean, if there's this prejudgment award, I doubt it's from the beginning of the lawsuit because the damage has been done since the net worth sweep of 2010. So it got me thinking. I did say that it's not rocket surgery, but you might think it's rocket surgery. There's just a lot of different pieces to this. It did get me thinking that potentially that Fannie Mae and Freddie Mac, after shareholders, after fighting for 13 years, yeah, I mean, they're probably in the right in terms of suing the government about them taking profits, not paying dividends on their preferred stocks, etc. And that if the court has decided that they're going to provide a prejudgment interest, well, how far back should it go? I mean, yeah, I mean, in theory, they should go back to 2010, right? I mean, so theoretically, they would pay all the dividends from 2010 plus interest on it from that time. Now, interest rates for a lot of that period were 0 and 1%, so it wouldn't be a lot necessarily, but it would be a pretty big number overall on the total bill. The other thing that it implies, which is that the original court judgment implied that that the government did kind of like take those profits that actually belonged to the shareholders. And if that's right, well, then this whole thing sort of like, kind of like makes you just think through like, well, how is this going to resolve itself? It's not just a simple court case where there's 612 million and the entity, the organization, the company just can write a check for $600 million. I mean, first of all, it's unclear how Fannie Mae or Freddie Mac, or is it the companies that are going to have to pay the 612 million, or will it be the actual government, the Treasury Department? Will it be the Department of, some other department? Will it be the regulator? Will it be the U.S. Treasury? It's unclear. And then if they're on the hook for 612 million, and the reason why, at least my understanding, others of you with a greater legal knowledge may disagree, or you may have better information, okay, that's fine. Like, this is my understanding. And it's based on following this case for a very, very long time, which is that if whoever is on the hook, it's the US government, it's the companies, the regulator, it's the Treasury Department. If they're on the hook for 612 million, and I believe the lawsuit sort of, was from a company called Berkeley. I believe there was an insurance company that owned some of the preferred, some of the common. Well, why wouldn't they be on the hook for all of the money? I mean, like, in other words, all the profits that were taken, all the dividends that weren't paid. I can't think of an answer why, other than, it seems like so crazy that it's not allowed to be thought about, or people think like, well, stuff can't happen. And then if you go back to this original question of like, well, okay, how will the government pay back 612 million? Or let's say this court case now sets a precedent, and now other uh, uh, folks that used to own the preferreds or common say, you know what, I'm going to go and try and get a court and to get a jury verdict on other aspects of this case. In other words, for other preferreds, for all the profits that were taken. And at that point, the government, at the potential of losing case after case, that essentially now increases the liability. Well, at some point, will the wheels start turning at the Treasury Department, in the government, at FHFA, which is the regulator for Fannie Mae? It's like, well, should we just like turn this all back to 2008? I know it seems like a crazy thought, but I mean, where is the government going to come up with billions of dollars to pay off Fannie Mae and Freddie Mac shareholders? How are they going to make them whole? Where is this money going to come from? I mean, they're still essentially owned by the government, and they've got some amount of reserves, etc. But if they have to pay it out, that would be trouble, especially in the current housing market where Fannie Mae and Freddie Mac still, I mean, they dominate what they do. And what they do is they buy up loans, mortgage loans from banks or any other institutions, package them up and sell them out as bonds. And, these bonds are held by central banks, by countries around the world. I mean, they're an important critical block of the financial system, which is why the government did what it did in 2008. How are they going to do this? I can't come up with an easy answer. One of the easier answers is really for them to undo what they did in 2008. In other words, they did a transaction where they became, they gave themselves preferred stock, which essentially, gave them majority ownership of the company. So let's say they gave up their senior preferred position. The other things that they could do once they did that and sort of like gave the company over, in other words, give the companies independence, take them out of this conservatorship that they've been in since 2008, and let the companies determine how to sort of like sort out all these, claims and awards and damages that are, in my opinion, coming. How might they do that? Well, I mean, certainly with the preferred stocks, and we own, just to be clear, we own the common in our gold tier. We own a number of preferreds in our gold tier. Go check out, which ones, if you're a subscriber. Maybe they convert those preferreds to stocks to avoid having to pay all those like accumulated dividends or the interest on it. Or else maybe, I have to look at the notes. They do go back to paying the preferreds back. In other words, preferred stocks essentially like loans, so maybe they pay back at par. Either way, it's a crazy situation that is potentially sitting out there. Is it guaranteed to happen? Is it going to happen? Well, the odds and the length of time that it has taken suggest no. But when you go through the actual fact set, yeah, I mean, if a court says that like you're on the hook, you did something wrong and you owe people all this money because you took something that was theirs, that didn't belong to you, even if you're the government, you're required to follow the law. So I don't really know specifically what's going to happen. In the end, there's only a few things that can happen. These companies are set free from the conservatorship, and they have to recapitalize in some way, which would require the government to give up its senior preferred, sort of give up any claims, allow the companies to kind of like sort through this mess, Maybe they'll pay back the preferreds. Maybe they'll start repaying the dividends. Maybe they'll settle on some basis with the shareholders for the interest. Who knows? But bottom line, my sense and feeling is, no guarantees, that this Fannie Mae Freddie Mac saga is nearing the end. I mean, what, 15 years after it began in 2008, 13 years after the net worth sweep was controversially implemented, something is going to happen in the next 6 to 12 months to close this out. And if it did happen, what are some potential outcomes? Yeah, I mean, these are fantasy outcomes to some extent, but you know what? Stuff happens in the markets. I mean, it seems crazy, but I mean, in 2008, all those famous hedge fund managers, Michael Burry and others in the Big Short, like, I mean, they made gigantic amounts of money that nobody thought that they should ever make or could make. Could it happen again? I mean, I think in my video, I called it, a reverse waterfall. Could we have a reverse waterfall where Fannie Mae and Freddie Mac go back to sort of like the 2008 early crisis levels, which would be for Freddie Mac, for FMCC, 20 to 30 bucks, Fannie Mae, $30 to $40. The preferreds go back to their par, which is 25 or 30 or 40 or $50. Or else the preferreds get converted to common stock, and then these companies start to trade like every other company based on their sales, based on their revenues, based on their book value, based on the future of their businesses. What is going to happen? We don't know yet, but hey, if you wait until after, then the price will have already rocketed up. So that's the game in finance. You got to buy in before you know the answer. That way, when the answer comes and the price lifts up, and you get the gains. So you got to take the risk to potentially get the gains. If you want to know what's going on a more regular basis, you can obviously subscribe to Atg Digital Media. The Fannie Mae and Freddie Mac are in our gold tier along with 3 of the preferreds. But truthfully, you can go and do all of this research yourself. You can go find the preferreds. Obviously, I've given you the ticker symbols for Fannie Mae and Freddie Mac. It's FNMA, FMCC. But remember, this is not investment advice. This is my opinion. This is information, engagement, and for some, entertainment. All right, that's this week's video. Hope you liked it. This is Paul saying bye.